There are many examples of successful investors, but the success rate is very low. It is said that less than 5% people become successful in investing. What is investing? What is investing in stock market? This is what we are going to discuss today. One of the greatest investor of all time is Mr. Warren Buffett. Today, the net worth of Warren Buffett is $108 billion. In Indian rupees, it is more than 7 lakh crores. In India, there are more successful investors like Rakesh Jhunjhunwala, Radhakishan Damani, and many more. So, what is making them different? Why they are becoming successful? How they have become successful? What strategies they have applied? When 95% of the people have failed in this game of investing, how Warren Buffett, Rakesh Jhunjhunwala, and many more have become successful. So this is what we are going to discuss today. When all the kids were busy playing in the garden, playing in the park, watching cartoons, reading comics, Warren Buffett at the time was busy watching business news and reading business journals and financial statements. In today's video, I am going to discuss about investing in share market and how one can become successful investors. What are the factors that one needs to focus on? Most of the people, they get confused between saving and investment. There is a difference between saving and investment. So let us first try to understand the basic difference between savings and investment. The most important difference between savings and investment is the two factor, that is risk and return. The risk in saving is very low and the risk in investment is quite high. So the return in the saving is less as compared to investment. The data in India says that very less number of people are investors in share market and there are large number of savers. But even though because of the COVID, the saving rate even though have reduced, but still the investor in the share market is very low. As you can see the data, less than 6% people invest in stock market according to the data given in the website Bombay Stock Exchange. Why do people save money? The main purpose of saving money is investment. So when they save money, the rate of return, the maximum rate of return which they can earn is less than 7%. But when we consider inflation rate, then the return will be sometimes in negative. There are different avenues one can invest, as you can see the chart out here. People can invest in FD, fixed deposits, they can invest in golds, they can invest in real estate and many more. You can see the chart out here. But the data says that the return from the stock market is highest. If we see the 10 years data, the return of Nifty 50 is 176%. If we see the data of 10 years, the return from the stock market is very high. It's nearly 176% in 10 years if you see the return of Nifty 50. Whereas the return from the gold is less than 136%. But there are many articles I have gone through which says that gold has a higher return when it is compared to the return from Sensex. But if we see the return from Nifty, it is more. So this is a market which gives a huge investment. But why most people are not investing in stock market, there are few reasons. The reasons are: one is risk taking capacity. The people have very less risk taking capacity. Or in a country like India, where most of the people save their money in banks, saving accounts, they do not want to take the risk. They have very low risk appetite, because of which they cannot invest in the stock market or share market, and they are not able to generate high returns. The other most important thing, the other most important factor is education. People are not much educated about the knowledge of stock market. And the other most important factor is that people are also not aware there are certain courses related to stock market where they can learn about stock market. As you go in the website of National Stock Exchange, you can see here the numerous courses in stock market. One can do postgraduate course in stock market, undergraduate course in stock market, and there are multiple offline and online courses which National Stock Exchange provides. The another factor is people, when they read news, they come to know that there are few scams in the stock market. Or all of us are aware about the Harshad Mehta scam, Satyam scam. But even though there were many scams, few investors like Rakesh Jhunjhunwala, Radhakishan Damani, and many more were very successful in tapping the market. How is it so? Not only about Warren Buffett, but there are many good investors in our country, India. Rakesh Jhunjhunwala is also known as the Warren Buffett of India. So how they do select the companies so that they can buy shares of that company? These are the things which we need to understand. So that is why the most important factor is awareness, being educated about this market. So let us be ready. Let us understand how stock market works. If we have to understand about the share market, first you need to focus on the word market. Like you go to a normal market to buy vegetables, to buy potato, to buy onions. When you go to market and when you ask the price of, say, onion, and if the seller says you that the price of onion is 50 per kg, you will say at that time, you will try to bargain the price. You will say that I'll be paying you 40 rupees. At that time, there will be a negotiation, and if the supply of onion is very less as compared to demand, then the seller of the onion is not going to reduce the price. But if the supply of onion is more, then the seller is going to decrease the price for you. So both the seller and the buyer will come in a common consensus. The price of the onion be 45 rupees. Likewise, share market is a market where we can get shares of different companies. Some are selling the shares, some are buying the shares. And people, they negotiate between the prices. Like the normal market, share market, the prices of the shares also is dependent on demand and supply. So the simple funda is about demand and supply. Now, you must be thinking that whether you can go to a market, normal market, and you can buy shares. Because when I was talking with one of my friend, he had a belief that in order to buy the shares of a company, he had to go to that particular company. But it is not like that. The market, the share market is in Bombay. Like the normal market, the market for share is National Stock Exchange and Bombay Stock Exchange. Both this market is situated in Mumbai. Now you must be thinking that, like, you go to a normal market, you will have to go to Mumbai to buy or sell the shares. But it is not like that right now. Because of the advent of the technology, there are many brokers who provide us with a platform where online platform online platform through which we can buy and sell the shares easily from the comfort of our house. So which is known as demat account. Now you must be knowing about demat account. So in order to buy or sell the shares, we need to have an account which is known as demat account. So these demat accounts are provided by different brokers. Now if you want to know about the stock brokers, you can watch my video I have made in my YouTube channel. So what are the different types of stockbrokers and how to select the best stockbrokers? For this, please go to my channel and watch my video. The best thing right now is by staying at home, we can buy and sell shares using the technology. But this also have become a problem because many of the youths, many of the people, they watch YouTube channels and they see that people are earning lots of money by trading, and they too think that they can earn money from the stock market in a very short period of time. But this is a very wrong decision. In advance, we will be knowing that what is the price of a vegetable, and then we go to a market. But why in stock market we are not doing research? Why we are, giving our hard-earned money to someone else? Why we are investing by listening to other people's tip? So that is the reason why doing research and doing a lot of hard work is very much important if you want to become successful in share market. Now, what they do is they start taking tips from their friends. They start taking tips from business channels, from newspapers, from teachers, and many more. But we need to think that do we take tips before buying potato or any vegetables? No. We ourselves go to market. Before going to market, we do a little bit of research. In advance, we will be knowing that what is the price of a vegetable, and then we go to a market. But why in stock market we are not doing research? Why we are, giving our hard-earned money to someone else? Why we are investing by listening to other people's tip? So that is the reason why doing research and doing a lot of hard work is very much important if you want to become successful in share market. Taking tips and investing in the stock market is one of the main reasons why people fail in share market. Forget about other people, but even the commerce graduates who have studied about the subject of stock market or share market, even they are not confident in investing in the shares. Why? Because one of the most important reason is that they are only taught about the theoretical aspect of the share market. They are not taught how to practically buy or sell and how to practically invest in the share market. This is one of the main reasons. Now I'm sharing few very important points which you need to understand before you start investing in the share market. First is you'll have to have a basic concept of index. In National Stock Exchange, Nifty 50 is the index. In Bombay Stock Exchange, Sensex is the index. The concept of this index, Nifty 50, is that even though there are more than 3,000 companies listed in the stock exchange, only few 50 companies, 50 best performing companies shares are taken as a barometer. So the value of Nifty 50 will also represent the performance of share market. In simple words, the fall and rise in the value of Nifty 50 will also represent the performance of share market as a whole. If you want to know more about index, please let me know in the comment box. I'll be coming with the next video based on index. What is index? How it is calculated? What is the functions of Nifty 50? And how we can know the performance of the overall market by looking into the performance of Nifty 50. Since you have already understood that before investing in the share market, you should look into the Nifty 50 or Sensex. The second most important thing which you need to understand is you need to understand the concept of value. Like when we go for a shopping and before we pay the price, normally we think that whether the price which we are paying is overvalued or undervalued. That we do when we buy a house, that we do when we buy a mobile phone. Like before paying certain price for a mobile phone, what we do is we want to know the utility of that mobile phone. We normally compare the price of the phone with the features. The same way, we need to understand the concept of value in share market if you want to become an investor. And the next important thing which the investor need to understand is the concept of value. So one should invest when it is undervalued and sell when it is overvalued. So what actually is value and how to know that whether it is overvalued or undervalued? This can be known with the concept of PE ratio, which is known as price earning ratio. So the price earning ratio helps us to know whether the value of Nifty 50 is undervalued or overvalued. There is a simple concept that when Nifty 50 has lesser PE ratio, then it means that the overall market is undervalued. And when the price earning ratio of Nifty 50 is more, it means that the overall market is overvalued. As you can see here, that when you go to the website of NSE, you will get to know the value of PE ratio for different years. So we'll have to see that what is the current PE and what was the lowest PE. That we can do in a year-wise data, or we can see 5 years data. So the data says, as you can see here, that within 5 years, the lowest data for PE ratio for Nifty 50 was around 18, and right now the value is around 38. So if we see the data of 5 years for PE ratio, the lowest is 18. So it is advisable to think about investment in Nifty 50 when it touches the lowest point of PE. So from 38, when it reduces to a level of 18, then that is the best time to think about investment. All of us know that from last year, the stock market have risen to a highest level of 15,400, and the highest PE we saw was around 40. So now in the month of May, the PE right now is around 29. So whether it is the time to make an investment or whether we should do it, that we need to think. But it is better that if we start investing when the PE is in the lowest level, that is around 18. This means that when the PE is 18 for Nifty 50, it means that the overall market is undervalued. After we get convinced that the Nifty 50 is undervalued in terms of PE, then the most important factor is we should know every company also has PE ratio. But before selecting a sector, we need to understand the concept of sector. So what actually is sector? A sector, it means that all the similar companies taken together, if they are doing the same business, then it is known as sector. So there are banking sector where all the banking companies taken together, and there are automobile sector where all the automobile companies are taken together. Likewise, there are FMCG sector. Likewise, there are different sectors which are related to aviation, tourism. So the best thing is we need to analyze the PE ratio of those sectors, and we need to see that we need to select the sector which has the lowest price earning ratio. And you can see here that there are different sectors, and the PE for each sector can be seen. So once we have selected the sector which has the lowest PE, after that we'll have to find a company in that sector. Say for example, suppose banking sector is having a lowest PE. So within that banking sector, we'll have to find a bank which has the lowest PE. After you get a company which have a very low price earning ratio, the story does not end here, but the story starts. We need to start analyzing about that company. We need to analyze the financial statement of that company. There are certain parameters which says that whether that company is in good financial health or not. So we need to find the sales growth of that company. We need to find how profitable that company is. We also need to check that how much loan or debt that company has. There are many other factors which we need to analyze about that company. This type of analysis is known as fundamental analysis. So I'm again revising the points for you all. Before you think about investing, you need to see the performance of Nifty 50 if you want to invest in National Stock Exchange. And once you are convinced that Nifty 50 is in its lowest level by looking into the price earning ratio, after that you'll have to find a sector which has a lowest PE. And once you have found a sector which have a lowest PE, you'll have to find a company which have a lowest PE. And once you have found a company, you should start analyzing different factors about those companies. So in the coming video, I'll be coming up with the concept about how to do the financial performance analysis of any company. There are few points which I would like to highlight. That investment is for longer duration. It can be more than 3 years, it can be more than 5 years. So you need to be aware of it, that investment is not a process by which you can become rich in one night or one day. It is a process. So you need to have a lot of patience. You need to do a research before you make an investment. There is also a myth that to invest in the share market, we need a lot of money. But it is not true every time, because there are various ways by which you can start investing in share market. One is you can have a lot of money and you can just invest by making a portfolio. So now you might be thinking, what is portfolio? So today I won't be discussing about portfolio, but in the coming videos I'll be coming up with the concept of portfolios. And the other most important thing is that we have only heard about mutual fund or SIP. Today I also would like to talk about DYSIP. So the concept of DYSIP is do it yourself systematic investment plan. So once you have selected 4-5 companies which have a very low price earning ratio and a very good fundamental with a very good technical points, you can start investing in those companies. You can put aside, say for example, you are earning 10,000 in a month, you can invest 500 per month. So every month you can set aside 500, Or if you are earning 50,000, you can keep aside 10,000. So every month with that 10,000, we can start buying those company shares. I also would like to tell you that the return from the gold is also very high. And in a country like India, all of us would like to invest in gold. But there is a difference between investing in gold and share. Because when we invest in gold, the return from the gold is only when we sell it. But if we select a company which have a very good fundamental, those companies will give us dividends, will sometimes give us bonus shares. So in the coming videos, I'll be talking about what is bonus shares, what is dividends. Because even if we do not sell the shares, till the time we hold, we will be getting dividends also. So dividend is obviously money, extra money in our investment. So that is why investing in share market is quite good over a period of time. So now you can see here, I can quote few examples that had we invested in few companies before 20 years or 30 years, I can give you the example of Eicher Motor. So you can see the value of Eicher Motor and before many years, say the value of Eicher Motor in 2004 was this much, and now the value of Eicher Motor is this much after split. So this is the calculation you can see here. This much amount of money you would have earned in Eicher Motor. Not only Eicher Motor, I'll give you a few current examples. Like last year, the company RVNL. The share price of RVNL was around 10 rupees, you can see here. Right now, the price is 30 rupees. So it was only 10 rupees. If you even had invested only 1 lakh or 10,000, you can just imagine this would have been your return. So I would like to talk about Reddington also. You can see the price of Reddington last year was this much, and this is the return. So there are few companies which I had selected, but I am not promoting these companies or shares. I also would like to tell you that I am not a SEBI registered advisor. This is just for education purpose. And I also would be very happy to share with you all that in Sikkim, Manipal University, we have a collaboration with National Stock Exchange Academy, and we are providing course on NCCMP, which is a 100 hours course where we teach students about the concept about fundamental analysis and technical analysis and all about basics of stock market. The course fee is also very less, and there is an option to pay on the installment basis also. So for that you can go onto this link, or you can share your views on the comment box.